Everyone thinks the Asian financial crisis was about currencies. They'll tell you Thailand's baht collapsed in July 1997 and that was the spark. They'll say it spread to Indonesia, South Korea, Malaysia, and the rest like dominoes. They'll blame speculative investors, political mismanagement, and a lack of transparency. That's the story in textbooks, finance documentaries, and IMF press releases. But that story hides the real one. Because currencies don't just fall out of the sky. Speculators don't just randomly pick countries to destroy. And 7 economies don't collapse in a single season, unless something much deeper is wrong beneath the surface. The truth is unsettling. This wasn't a panic. It was an exposure. The numbers had outgrown the promises. And what collapsed that night wasn't just paper money. It was a dream sold across Asia in the 1990s. The dream that if you copied Western markets, opened your doors to capital, deregulated your banks, and pegged your currency to the US dollar, then prosperity would be automatic. But it wasn't prosperity. It was leverage. Borrowed in dollars, invested in real estate, insured by central banks that couldn't print the currency they owed. It was a giant regional carry trade disguised as development. And when interest rates rose in the United States and the dollar strengthened, it all began to crack. Because what goes up with foreign money comes down with foreign exit. Thailand had $29 billion in foreign debt it couldn't repay. Indonesia's rupiah would lose 83% of its value. In South Korea, the mighty chaebols, Samsung, Daewoo, Hyundai, teetered on bankruptcy. The IMF came in, but its bailouts came with strings that snapped entire social contracts. So here's the paradox. Asia was growing, modernizing, industrializing. But the very policies that made it look rich were the same ones that made it fragile. Just like the subprime bubble in 2008, just like the Eurozone crisis in 2010, just like now, when entire nations are again borrowing in foreign currencies, pledging real assets for imaginary flows of capital, and hoping trust will last just a little longer. It never does. Because systems don't collapse when people stop believing. They collapse when trust is still high, but math no longer works. It didn't start in 1997. To understand how 7 economies collapsed in one season, we need to rewind. Not just to the early 90s, not even to the 80s, but to 1971, the year money was unanchored from gold, and the global financial system became a floating web of debt, trust, and capital flow. That's when the game changed. Because before 71, nations couldn't just borrow endlessly in dollars. There were limits, not political ones, but physical. You needed gold, or trade surpluses. But once Nixon closed the gold window, the dollar became untethered, and the American financial system found its new export, money itself. Fast forward to the 1980s. Asia is rising. Japan is already an economic giant. The Asian tigers, South Korea, Taiwan, Singapore, and Hong Kong, are sprinting toward modernization. Their success becomes a model. And across Southeast Asia, a new class of reformers, technocrats, and Western-trained economists begin to ask, how do we grow like them? The answer, they're told, is simple. Integrate into the global market. Open your capital accounts. Invite foreign investment. Privatize state industries. Deregulate finance. And above all, peg your currency to the dollar. A dollar peg sounds technical, but it's just a promise. Our money will always be worth this much in US dollars. That stabilizes trade, attracts capital, and reassures foreign investors. It says, you can come in, buy our assets, build your factories, and you won't lose on currency fluctuations. It's like offering tourists a guaranteed exchange rate. But behind that promise sits a central bank, one that now has to defend the peg. If dollars leave, the bank must step in and sell its reserves to maintain the value. It's like trying to hold back a tide with a bucket. Still, during the 1990s, it looked like a miracle. Thailand, Malaysia, Indonesia, they were growing at 7 to 9% per year. The skylines of Bangkok and Kuala Lumpur rose like something out of Manhattan. Infrastructure boomed. Consumer credit exploded. Local tycoons and conglomerates borrowed in dollars, billions at a time, because the rates were lower and the exchange rate looked stable. But stable is not the same as safe. Because here's the secret no one told them. When you peg your currency to the dollar, but borrow in dollars, and your economy depends on short-term inflows of capital, you're not in control. You've surrendered your sovereignty to foreign interest rates and investor moods, and those moods can change overnight. Still, Washington applauded it all. Wall Street funded it. The IMF praised it. These countries were called emerging markets, as if they were just baby versions of mature capitalist economies, bound to grow up and join the family. But what they were actually building was a one-way system. Dollars came in, attracted by high returns, cheap labor, and the promise of a fixed exchange rate. The money flowed into real estate, stock markets, infrastructure, and ambitious mega projects. Banks, many of them politically connected, lent recklessly. Regulations were weak or newly written. And central banks, they were expected to play by the same rules as the Fed, but without the same powers. Because the Fed could print dollars, Thailand couldn't. So the foundation was flawed from the start. These were open economies with closed political systems, modern financial sectors built on ancient patronage networks, and exchange rate promises backed not by gold or trade surplus, but by optimism. The math didn't work. By the mid-1990s, Thailand's foreign liabilities had reached $89 billion, half of it short-term. Indonesia's corporations were borrowing dollars hand over fist. South Korea's banks were rolling over foreign loans monthly just to keep the music playing. And across the region, a dangerous assumption had taken root, that capital would always flow in, never out. It was the same assumption made in Argentina in the late 1990s, the same mistake made by Euro periphery countries in 2008, the belief that if you just follow the rules of globalization, markets will reward you forever. But capital has no loyalty. It's not patient, and it doesn't vote. The system they built was not an economy. It was a circuit. Money in, real estate up, more borrowing, more inflows, repeat, until the direction reverses. And all those promises, the dollar pegs, the growth rates, the development dreams, collide with a basic, brutal rule of finance. You cannot borrow in a currency you cannot print forever. That's not an opinion, that's arithmetic. Booms are always beautiful from the outside. In the early to mid-1990s, Asia was glowing. It wasn't just growth, it was the sense that history had flipped. Once colonized nations were now outperforming their old masters. Western economists coined terms like Asian miracle. Foreign journalists filmed skyscrapers rising in Jakarta, highways in Bangkok, stock market rallies in Kuala Lumpur. The region looked unstoppable. And if you lived there, you felt it. The streets were filled with new cars. Tech companies mushroomed. Shopping malls gleamed with foreign brands. Everyone from bankers to students believed the same thing. We've cracked the code. But what they cracked wasn't a miracle. It was a loop. One powered by cheap credit, rising asset prices, and the illusion of control. Here's how it worked. Money poured in from abroad, mostly in dollars. Foreign investors, especially from Japan and the United States, were eager to ride the Asian tiger. Local governments and banks welcomed it, converting those dollars into local currency and lending it out domestically. Developers borrowed, industrialists borrowed, even governments borrowed, often off balance sheet through state-linked banks or agencies. And the borrowing fueled a frenzy. In Thailand, office space in Bangkok tripled between 1990 and 1996. In Malaysia, giant infrastructure projects, airports, rails, the Petronas Towers, were financed with external debt. In Indonesia, conglomerates with ties to the Suharto family borrowed billions in US dollars and used the money to speculate in land and luxury. This wasn't isolated. South Korea's chaebols, massive industrial groups like Daewoo and Hynix, were expanding globally, backed by state-directed credit. They too borrowed abroad in dollars. Their logic was simple. The economy is growing at 8 to 10% a year. The currency is pegged to the dollar, and American interest rates are low. It felt like free money. And as asset prices rose, land, stocks, factories, banks looked more profitable, companies more valuable. More inflows followed. Credit ratings improved. The IMF and World Bank pointed to Asia as proof that globalization worked. Even Wall Street began launching Asian Tiger mutual funds, selling them to Western investors as the next big thing. But it was a bubble, not in the classic sense of tulips or tech stocks, but a systemic leverage bubble based on foreign currency liabilities and short-term trust. And under the surface, the cracks were growing. Many of the investments weren't productive, they were speculative. Real estate built for tenants that never came, factories that overproduced steel, semiconductors, and textiles for export markets that were slowing, banks that reported profits while hiding non-performing loans. In Thailand, the financial sector had become a shadow maze. Over 90% of its capital inflows were short-term, bets, not investments. The infamous Bangkok International Banking Facility allowed domestic banks to borrow offshore and relend domestically in baht, multiplying exposure. The whole thing depended on the baht staying stable. In Indonesia, conglomerates engaged in currency mismatches so massive they became blind to risk, borrowing dollars, earning in rupiah. It worked until it didn't. But why did everyone believe it would continue? Because the numbers said so. GDP was rising, credit was expanding, currency values were stable, reserves looked healthy. The IMF and credit agencies issued optimistic reports, and in finance, momentum is hypnotic, especially when it's backed by technocratic language and foreign approval. No one saw it coming because no one wanted to. Local elites were profiting, foreign investors were making returns, politicians were re-elected, and ordinary people were told, this is what development looks like. This is the modern path. But it wasn't modern. It was fragile. Because all of it, the towers, the credit, the sense of unstoppable progress, rested on a silent assumption that dollars would always be available, that foreign investors would always stay, that pegs would hold, that risk could be ignored. But as we know now, risk doesn't disappear. It just compounds. And once again, we find the pattern. They did it in France in the 1780s with assignats, paper money backed by future faith. They did it in Latin America in the 1980s with petrodollar debts. They did it in the US in 2006 with subprime mortgages disguised as AAA assets. They believed a system built on borrowed time could last forever. It never does, because illusions grow the fastest right before they break. If you're beginning to see how belief, credit, and growth can turn into a trap, share this video. Somewhere in the world, it's happening again. It began with a whisper and ended like a bomb. In May 1997, currency traders started quietly betting against the Thai baht. Nothing explosive yet, just a sense that something was off. Thailand's current account deficit had ballooned to over 8% of GDP. Foreign debt was rising faster than exports. And investors, the same ones who had flooded the country with billions, were beginning to pull money out. By July, the dam broke. Thailand ran out of dollars. Its central bank, the Bank of Thailand, had spent nearly $30 billion trying to defend the baht, but the outflows kept coming. Speculators smelled blood. George Soros's Quantum Fund and others launched coordinated attacks. On July 2, 1997, Thailand abandoned its peg. The baht collapsed. That's when the contagion started. Because this wasn't just about Thailand anymore. Investors looked around and realized every major Asian economy had the same disease: overvalued currencies, massive foreign debt, dollar-denominated liabilities, fragile banks, and political elites pretending nothing was wrong. Indonesia, Malaysia, the Philippines all began to unravel. By August, Indonesia's rupiah was down 10%, then 20%. Then 50%. Local businesses that had borrowed in US dollars suddenly found themselves owing double with no way to repay. The currency had collapsed, but the debt stayed in dollars. That's the cruelty of external debt. When your money weakens, your obligations get stronger. Entire companies vanished in weeks. In Jakarta, office towers sat half-finished, abandoned by bankrupt developers. In Manila, food prices spiked. In Kuala Lumpur, capital controls were rushed in to stem the bleeding. In Seoul, the mighty chaebols, which had looked invincible, began to fall one by one. Hanbo, Kia, Daewoo. Too big to fail? Not anymore. And the Korean won? Down 50%. By December, South Korea, one of the world's top 15 economies, was begging the IMF for a $58 billion bailout. But that bailout came with terms. The IMF, controlled largely by US and European interests, didn't just offer money. It demanded restructuring, austerity, massive layoffs, higher interest rates, privatization of state assets, removal of capital controls. It was economic shock therapy, imposed at the moment of maximum vulnerability. So let's be clear, this wasn't just a financial crisis. It was a transfer of power. Local currencies collapsed, local industries imploded. But foreign creditors, hedge funds, and multilateral institutions got priority. They were repaid first, with interest. Central banks sold gold, reserves, and national assets to make those payments. In Indonesia, the IMF ordered the closure of 16 banks in one night. Panic followed. Bank runs swept the country. Suharto, who had ruled for over 30 years, was gone by May 1998. The collapse wasn't just economic. It cracked political regimes, social contracts, and national psyches. And underneath it all, the numbers were unforgiving. Because once a country borrows in dollars and promises a fixed exchange rate, it's walking a tightrope. Any slip, trade deficit, political scandal, interest rate hike abroad can trigger a fall. And once capital starts leaving, the central bank can either defend the currency by raising rates and draining reserves, or let it crash. Either way, the public pays. Jobs vanish, prices soar, debt explodes, foreign ownership increases, and the elite who brought the system in, they usually get bailed out. Sound familiar? It happened again in 2001 in Argentina, in 2008 in Iceland, in 2010 in Greece. Even now, in countries from Sri Lanka to Egypt, the same math plays out. Dollar debt plus weak exports plus capital outflow equals collapse. It's not ideology, it's arithmetic. The great illusion of the 1990s was that globalization had found a formula, that open capital markets, pegged exchange rates, and Western-style banking would lift all boats. But boats only float if the tide rises evenly. In Asia, the tide was debt, and when it went out, only a few were wearing life vests. Foreign investors, IMF technocrats, and the banks that made the loans in the first place. Everyone else, workers, pensioners, students, small businesses, got swept away. The moment of collapse was not when the bot fell. It was when the truth became visible, that the system had been fragile all along, held together by borrowed confidence in foreign capital. And when confidence left, so did everything else. Crises don't end, they evolve. By the end of 1998, the headlines faded. The IMF declared success. Currencies stabilized. Stock markets recovered. Leaders were replaced. Reforms were signed. And Asia, the narrative went, had learned its lesson. But had it? Because if we look closely, the lesson was not don't borrow too much in dollars. It wasn't don't peg your currency while opening your capital account. The real lesson, absorbed quietly by finance ministers and technocrats across the developing world, was something darker. Never trust the West to save you. After 1997, central banks from Seoul to Kuala Lumpur began hoarding US dollars like lifeboats, not spending them, stockpiling them. That's why in the 2000s we saw the rise of what economists call global imbalances, developing countries running huge trade surpluses, then parking the earnings in US Treasury bonds. It wasn't charity, it was protection. They weren't going to be caught short again. China watched the crisis closely. It saw what happened to Thailand when it let capital flow freely. It saw what happened to Indonesia when the IMF imposed foreign terms. So instead of opening its capital account, China built up the largest pile of dollar reserves the world had ever seen. By 2008, it held over $2 trillion, mostly in US debt. This was the post-crisis pivot, from debtor to creditor, from borrower to insurer. But the system didn't disappear, it just moved. Today, the same logic, dollar debt, fragile pegs, capital inflows chasing yield, still runs the world economy. Only now the names have changed. Instead of Thailand, it's Turkey. Instead of Indonesia, it's Argentina. Instead of South Korea's chaebols, it's Egypt's military-run industries or Ghana's offshore gas projects. In 2022, Sri Lanka defaulted on its foreign debt for the first time in history. The cause? Massive dollar liabilities, tourism collapse, rising U.S. interest rates, and a government that had believed, like Asia once did, that growth would protect them. It didn't. Because the mechanism is still in place, The world runs on dollars, but most countries don't print them. They borrow them through bonds, trade finance, or direct loans. When the dollar is weak and rates are low, it looks easy. But when the Federal Reserve tightens policy, like it did in the late 90s, like it's doing now, the cracks return. And again, we see the cycle. Capital flows in during the boom and flees during the bust. Currency weakens, debt explodes, food and fuel prices spike, and people riot. In 2022 alone, over 50 countries faced a heightened risk of debt distress, not because of corruption or bad budgeting, but because their dollar obligations became unpayable in their own currency. Sound familiar? It should. The Asian crisis wasn't an isolated accident. It was a prototype. The global financial system incentivizes short-term inflows, penalizes self-reliance, and rewards the illusion of stability until that illusion fails. It's a system where central banks in Nigeria or Pakistan have to defend against decisions made in Washington, where a small rate hike in the US can bankrupt a province in Zambia or spike rice prices in Laos. And every time, the response is the same. The IMF arrives, offers dollars, demands cuts. Public sector wages freeze, fuel subsidies vanish, infrastructure halts. Meanwhile, creditors, usually Western banks or hedge funds, get paid first. What changed since 1997? Not the structure, just the story. Today, instead of Asian tigers, we hear emerging markets. Instead of currency crisis, we hear tightening liquidity conditions. Instead of IMF rescue, we hear structural reform packages. The words have changed, but the mechanism remains. And yes, there are new players. China now lends more to the global south than the World Bank. Gulf countries backstop struggling economies with oil-backed swaps. Crypto has emerged as a shadow channel for capital movement. But underneath, the dependency remains. Countries still borrow in currencies they don't control. They still build boom-bust cycles on the back of hot money. And they still find themselves, in crisis, negotiating repayment with institutions that answer to someone else. That's not sovereignty. That's soft colonialism, enforced not with armies, but with spreadsheets. So if you hear that this time is different, be cautious. In 1996, everyone believed Asia was invincible. 1 year later, 30 million people were pushed back into poverty. Today, the world believes that the next crisis will be manageable because we've built better tools, smarter economists, faster responses. But no tool can fix a structure where arithmetic always wins. If this part helped you connect the 1997 crisis to what's happening today, share it with someone who still thinks financial collapse is just about bad governance. It rarely is. The problem isn't the headline, it's the wiring underneath. They say trust is the foundation of money, but that's not entirely true. Trust is only the mask. The real foundation, the one no one talks about, is arithmetic. The Asian financial crisis didn't happen because people lost faith. It didn't happen because of corruption or incompetence, or even the so-called irrational panic of investors. It happened because the numbers stopped adding up. Dollars were borrowed faster than they could be earned. Promises were made in a language no one could print. Growth was measured in credit, not productivity. And when the math broke, no amount of political speech or foreign advice could stop the collapse. It's easy to blame speculators, hedge funds, or foreign lenders, but they were only symptoms. The root problem was structural, a system that rewarded appearance over substance, velocity over value, and imitation over independence. And this is the danger of every miracle economy. It doesn't matter if it's Thailand in 1997, Argentina in 2001, Greece in 2010, or your country today. If your system depends on capital you don't control, on currencies you don't print, on flows you can't stop, then you are not sovereign. You are rented until the rent comes due, and it always does. Because systems don't collapse when they're weak, they collapse when they pretend to be strong for too long. They collapse when numbers outgrow gold, outgrow real income, outgrow the capacity of ordinary people to absorb the costs. They collapse when elite assurances hide the rising pressure, when everything looks fine until the day it isn't. So if you're hearing this in 2025 or 2035 and your government is still borrowing in foreign currency, still promising pegs, still chasing flows, understand where that road leads. It doesn't end in prosperity. It ends in liquidation. The only real defense is simple. Align promises with reality. Don't borrow what you can't repay. Don't fix what must be flexible. And never, never believe that a system based on unsustainable math will save you because it worked before. Because history doesn't repeat, it audits.